You pressed buy. The stock was up 40% that week. Everyone on the internet was talking about it. Your buddy already made $3,000, so you jumped in. And then it crashed. Not a little, a lot. And the worst part? You knew something felt off. But you bought anyway. Here's the thing nobody tells beginners. It wasn't bad luck. It wasn't bad timing. It was your brain. Your own psychology was working against you before you even opened that app. And today, we're going to pull back the curtain on exactly how that happens. And more importantly, what the smartest investors do differently. Let's start with something called herd mentality. It sounds obvious when you say it out loud. Don't follow the crowd. But in the moment, it feels completely rational. When thousands of people are buying the same stock, when your feed is flooded with screenshots of gains, your brain interprets that as proof. Proof that this is safe. Proof that you'd be stupid to miss out. This is ancient wiring. Humans survived by following the group. If everyone ran from something, you ran too. But financial markets aren't a predator in the jungle. The crowd is often wrong at exactly the worst moments. The peak of a bubble looks identical to the start of a rally. That's the trap. Now here's a bias that hits even harder, and almost nobody talks about it. It's called loss aversion. Researchers found that losing $100 feels about twice as painful as gaining $100 feels good. Read that again. The pain of losing is double the pleasure of winning. So what does your brain do? It avoids selling losing stocks because selling makes the loss real. It sells winning stocks too early because locking in a gain feels safe. You end up holding your worst investments and dumping your best ones. That's not a strategy. That's your emotions running the portfolio. And it's happening to millions of people right now without them even realizing it. Here's the one that makes people cringe when they see it in themselves. Hindsight bias. After a stock crashes, people say, I knew that was going to happen. After it rockets up, they say, I always believed in that company. The problem is, that's almost never true. But your memory rewrites itself. It fills in confidence that wasn't there. Why does this matter? Because if you believe you predicted things correctly, you start taking bigger risks next time. You think you have an edge you don't actually have. Hindsight bias turns lucky guesses into fake skill. And fake skill in investing eventually becomes a very expensive lesson. Let's talk about confirmation bias. You already believe something about a stock. Maybe you love the brand. Maybe a friend told you about it. Whatever the reason. So when you go to research it, guess what you find? Evidence that supports what you already think. Not because the evidence isn't there on both sides, but because your brain filters. It highlights the good news and skims past the warnings. Investors have held on to failing companies for years because every piece of negative information somehow felt like it didn't count. Meanwhile, the opposite signals were right there in plain sight. You're not reading the market. You're reading a story you already wrote. And then there's overconfidence bias. Studies consistently show that the majority of individual investors believe they perform better than average. Mathematically, that cannot be true. After a few winning trades, something shifts. You stop thinking about luck. You start thinking about skill. You take larger positions. You diversify less. You ignore the warnings. The market has a brutal way of correcting overconfidence, and it usually waits until you've gone in biggest to teach that lesson. The investors who last longest aren't the most confident ones. They're the ones who stay genuinely humble about what they don't know. This next one is everywhere, and it's getting worse. FOMO. Fear of missing out. Platforms are literally engineered to trigger it. Limited time offers. Everyone is buying this. Price alerts designed to create urgency. FOMO makes you skip research. It makes you buy at the top of a move because waiting feels like losing. And once you're in, loss aversion kicks in and won't let you get out. These biases don't work alone. They chain together. FOMO gets you in. Loss aversion keeps you stuck. Confirmation bias makes you feel okay about it. And then hindsight bias convinces you it was your plan all along. It's a cycle. And the exit is awareness. So what do the investors who actually win long-term do differently? First, they write things down before they invest, not after. They write down why they're buying, what would make them sell, and what they might be wrong about. That single habit destroys hindsight bias and keeps confirmation bias in check. Second, they build rules in advance. If this drops 15%, I sell. Not in the moment, before. Because in the moment, your emotions will always find a reason to wait. Third, they treat overconfidence as a red flag. When they start feeling certain, they slow down. Certainty in markets is almost always a warning sign, not a green light. Here's what this all comes down to. Every single person who has ever lost money in the market thought they were being logical. They had reasons, they had data, they had conviction. But the market doesn't care about your conviction. It doesn't care about your feelings. It responds to information, and it punishes emotional decision-making relentlessly. The good news? You now know what the biases are. Herd mentality, loss aversion, hindsight bias, confirmation bias, overconfidence, FOMO. Knowing them doesn't make you immune. But it gives you a split second of awareness before you act. And in investing, a split second is everything. If there's one thing you take from this, let it be this. The market is not the biggest threat to your money. Your own unexamined mind is. The investors who build real wealth over time aren't smarter than you. They've just done the internal work. They know where their brain lies to them. Start small. Write down your reasoning before every investment. Review your decisions honestly, not to punish yourself, but to learn. And if you want to go deeper on this, the next video on behavioral finance covers how anchoring bias specifically costs average investors thousands every year. It's worth watching before your next trade. The link is right there. No pressure, just value.